Without further much ado, let me invite our first keynote speaker, CA Rajiv Hira, who is the managing partner at RHM MC Management Consultants. Rajiv Hira, a high-caliber financial professional with an experience of leading roles in private and multinational financial institutions for over 25 years in the area of risk management, compliance, investment analysis, investment management, tax advisory, and management consulting. CA Rajiv has hands-on experience in engaging with regulators and governing bodies in the space of anti-money laundering and counterterrorism financing. This work involves understanding the strategic intent and implementation objectives for compliance.
CA Rajiv Hira, stage is all yours.
Thank you. I'm sure there's a lot more we want to talk about taxes today. So when the journey of taxes started, do we know when UAE introduced something to touch upon the corporate tax? Any guess, any kind of a wild thoughts which we have? Normally we say somewhere November, December, when the framework started off and the discussion came up. I think the answer lies in way before this corporate tax foundation was laid down in the country. And how? If you see, the journey is quite long and started somewhere in 2018. That's where the VAT got introduced in the country. So this is the milestones which we have seen how the corporate tax is being evolved or how the foundation of the taxes came up in this country. 2018, we saw value-added tax which came into the picture. 2018, again in the month of May, UAE became part of the BEPS framework, and that's where the base erosion profit shifting, reporting, and the standards came up. We will see a lot of those things getting imbibed as a part of a corporate tax also. In 2018, again in the month of September, a lot of action on 2018. AML framework got reinstated. There was a framework, but it got reinstated and came up in light where a lot of transaction activity got into a place. Now, do we think these are related? Definitely these are related. BEPS framework was on account of base erosion profit shifting. Anti-money laundering is looking at how those things are getting evolved, what kind of a transactions are getting conducted within the country. So everything what happened in previous few years has created a milestone, has created a foundation stone of how the corporate tax is going to evolve into. Further, it doesn't stop here. CBCR reporting came up from an OECD perspective, where country by country reporting came into picture, and the primary entity has to report those transactions. Further, 2019, economic substance regulation came. We all know the heavy penalties and fines and compliance things which came up as part of economic substance regulation. It doesn't stop there. Corporate tax also has a relevance to the substance requirement, especially in some of the specific sections which we are going to look at. 2020, again, the beneficial ownership. Now let's identify who are the people behind the company. This regulation got kicked in, there are a lot of things got evolved, but suddenly we found this became a talk of all the free zone authorities. They started looking at who are the people behind us, show us the warm bodies. That was the question. That was the answer which every authority was looking for. And it became quite open on the platforms also. And as we talk, the corporate tax is a way in 23, which is going to come up. So if you see the journey, I don't think the journey is completed. We are still trying to grapple a lot of information, trying to see how those things are getting evolved and come up and catch up to the corporate tax story. So that's the overall view of how the corporate tax is coming up. Now, the question comes is why? That's a why framework is also important in any law. When we see and when we look at what need to be done, that's an important part. But why this need to be done, if you understand, I think the compliance becomes much more easier and we understand the implication. So in legal language, we always say, don't look at the verb or the words, look at the intent. So we have to read both the words also and the intent also. I'm not saying ignore the words, but we have to catch up both the factors. Now there are two broad principles: tax transparency, which is a key note and which we have seen, which is started from 2018 itself, where they started looking at bringing the transparency. UBO is what? Is a transparency. We are trying to create the transparency in the transactions, in the structures, in the ownership, so that people are aware who are behind, what's happening, whom we are transacting with, and it became much more compliant from an AML perspective also. And the second thing is preventing harmful tax practices. That means we don't want this country to be misused by anyone for protecting the taxes, preventing the taxes, or routing a transaction in such a fashion that it becomes something incorrect or illogical from this country perspective. So these are the two pillars, or you can say two ground rules, which are being looked at how the corporate tax is going to evolve in this country. So these are principles which are being very effective and are important to see how those corporate tax implementation comes into play. Now, when will the corporate tax regime become effective? We all know. I don't think there is a lot of juggling and a lot of actions we need to see for, but still, every time we do a session, we do a talk, this question typically comes into. So it's starting from 1st June 2023. And if you look at a very simple example, if your financial year is from July to June, then you are the first one to catch up the corporate tax. If you are from Jan to December, then in 24 only your story starts in, or the corporate tax implementation starts in. And if you are in April to March, then 1st April 24 is where the tax implication or tax implementation will start. Now, do we think that we don't have to do anything from now onwards? Technically speaking, you may not be paying taxes, but the preparation work is not easy. There is a lot of groundwork which you need to look at, a lot of accounting GL code adjustments which need to be looked at. So it's good. First thing is, I definitely say congratulations to all of you that you started learning. You started being part of the seminars and events where we are sharing the knowledge, what we understood. From the questions, we get a lot of understanding on those topics also, and we go back, draw our understanding and come back. So that's a very important part which everyone is doing. Now, if you see, there are two headline rates discussion which is coming up. Normally, we are hearing that 375,000 dirhams is now being officially released, and we know up to 375,000 dirhams, there is no taxes, but that's not the complete story. If you are not a free zone company, that means you are not a qualified free zone. We will come back to that also. Then only that conditions will apply. That means if you are not a qualifying free zone, taxes up to 75,000 dirhams, which is approximately $100,000, there is a zero tax. Beyond that is going to be 9% taxes. But where qualifying free zone things comes into play, there are two categories of income: qualifying income, non-qualifying income. For qualifying income, you are allowed for a 0% tax. For non-qualifying income, there is no threshold. So that means from the dirham 1, the taxes calculation has to be done and to be paid. So if you're a free zone, you are a qualifying free zone. We'll talk about what is a qualifying free zone. Then it's not that you have a bracket of 375,000 as a zero tax. You have to segregate your income in two portions. Now, this can be one of the thought process which you need to look for. Do you want to be a qualifying free zone or not? Or it makes sense to take a threshold of 375,000 and pay taxes beyond that. So that permutation, combination, or calculations need to be reassessed once we have more details and executive regulation or the cabinet decisions when they come into. So two headline rates: 0% up to 375,000 dirhams, and beyond that 9%. For a free zone, break incomes into two parts: qualifying free zone income, non-qualifying free zone income. Qualifying free zone income, whatever income you do, 0% tax. Non-qualifying, whatever income you do, there is no threshold. So that means from dirham 1, you'll be paying 9% taxes. So that's the differential treatment which comes into play. Next comes, there is a scope of tax. We know any business being done by incorporated or unincorporated company or individual is going to be taxed. I'm using a word individual also with a conscious. In general, there is no personal tax, but if you do any business, now there is a very clear definition of business which we need to look at. Anything which is done on continuous basis and you generate a revenue from there. Now, there are a lot of examples which are there. I'll give a very typical example. I am a salaried employee. I work from 9 to 5. Normally, employees don't work from 9 to 5. Maybe they work from 9 to 10. So that's a work. But during the time, I have some spare time, or during my lunch time or coffee time, I go to any kind of a e-commerce company online. I search a product. Let's take an example of a car. I searched a car. I liked a car, maybe $100,000 car. I liked it. I purchased that car. Next day, I went to RTA, got it registered in my name. Perfectly fine. Third day, I said, let me sell this transaction because I don't like the vehicle or I'm getting a better deal. I got a deal of 120,000. I sold the vehicle. Now, in this case, I have taken the possession of the vehicle and the ownership also. That means I went to RTA, got the vehicle transferred in my name. I may not call it to be business. It's a personal effect which I used and I sold it. Now let's change the example a little bit, where I purchased the car for $100,000 and I've not transferred to the RTA. And while sitting in the evening with my friend said, wow, this is a fantastic car. This is my dream car. I want to buy it. Can you sell it for $150,000? I said, wow, in a night, I'm getting $50,000. Why not I sell it? So I took the buyer, took the seller, went to the RTA. The transaction happens between buyer and seller. I am not there in the picture of transfer. In this case, what I did a business. So we need to be very clear in our personal transaction also, whether this is qualifying as a business or a non-qualifying as a business. Now, in this case, $50,000 is my income. And if I do these kind of transactions beyond 375,000, welcome to the club. And the tax has to be looked at from an individual perspective also. So it's very clear, anything which requires a license to operate, or you're doing any business which is not a personal effect or not a personal transaction, you may tantamount to a corporate tax. It's not a personal tax, it's again a corporate tax only. Now, what is exempt on a high level? Any employment income is exempt. Any dividends which are being received from an entity who has already paid the corporate tax is going to be exempt on a high level, but there are more intricacies to it. And the investment income at an individual level are going to be exempt incomes. So these are at a high level how the transactions are going to be. Now it defines what are the taxable person. Brought two category: resident. Anyone who is incorporated in UAE or having a business in UAE or having a control in UAE is a resident of UAE from a tax perspective. So now one more definition which is coming out: are you a tax resident of the country or not? So that's where it's not only residency, are you a tax resident of the country or not is again one new definition which comes up to us. So a judicial person, whether incorporated or unincorporated, four friends came together, they did some business, legal, non-legal, took a license, not taken a license, we are not getting into that. But if you do a business as an unincorporated person, it is a business. Whether you have taken a license or not is a second penalty or second fine which will come into. That's a different discussion. But this is where it comes into. Judicial person that is incorporated in UAE. Anyway, it is incorporated in UAE and will be based on a taxation from a UAE perspective. A natural person, which we talked about, who conducts a business in UAE also is going to be a resident or a tax resident from a corporate tax perspective. And the last one comes anything which cabinet decision will supersede and say, these are four categories more which we want to be classified as resident. And the second thing comes is where we have a non-resident. It's a very interesting space, which is known in few countries as POEM, place of effective management or permanent establishment. If you have a permanent establishment in UAE, whether you like it or not, you will be taxed from a UAE perspective. Not only for UAE income, it goes beyond also. Or you derive source income, which is defined in Article 13. So that's also where you have a income which is sourced from UAE and you have a P in UAE. So if those conditions comes up, welcome to the family, and the taxes has to be looked from a UAE perspective. Again, last point, cabinet decision will come. Now, in maximum sections, you will see the cabinet will define what more need to be added as part of the section. So what we are expecting now is we are not expecting a single executive regulation or a rule book. We are expecting multiple cabinet decisions which will come up, and every section or every point will be elaborated from that perspective. So that's going to be very different than what we saw in the VAT regime or VAT era, what is going to happen from a corporate tax perspective. Just a quick snapshot. So if you are a legal person, anything which you do from a UAE perspective will be taxed. and taxed on a worldwide income. Now, worldwide income will be taxed. That's a one part, but you will get a benefit of any foreign taxes you paid, but you won't get a credit of that. So example, you are being taxed in UAE and you are having links from an India perspective. India, you paid 30-35%. You're not going to get that benefit of a refund, but the 9% equivalent will be adjusted. So that's where the benefit comes into. For a natural person, the benefit is if you are even classified as a person doing a business in UAE, you will not be taxed on a global income. It's only a UAE-centric transactions which will be looked at. Last thing is foreign companies. Again, same thing. Everything which is on a global basis. If your P has a or permanent establishment is defined as UAE. Now, this is a very tricky point. If you look at legislations across the countries, across the world, there is a lot of debate, deliberation happens on these P term. We have to remind ourselves, P is not only physically how attendance or how activities are done, even the IP of the laptops, how the communications are used, from which country those communications are used, also are looked into. So everything has to be brought up into a points of discussion when we come into. Now, there is something very interesting happened in two cases, where one is where you have where it's an unincorporated partnership. That means individuals are part of it, or you have a family foundation. UAE is a little bit unique. UAE has a lot of incorporated foundations also. Typically, ADGM, DIFC has family offices or family foundations which are being created. So in that case, there is a provision where you can apply for, the word is apply, you have to apply, it's not a by default. You have to apply for a transparency rule. The moment you apply for a transparency rule, they will eliminate the section of unincorporated partnership and foundation, and the individuals will be taxed based on what income is coming up. Now, that income can be a dividend, which may be exempt. That income can be a business, which may be taxed. So you need to look at those sections, but very specifically under both the sections, or specifically for family foundation, there are certain criteria which need to be met. The income has to be typically a dividend or for the purpose of generation of wealth. It's not the core business which is done in that foundation. So those are the criteria. If it happens, then you follow the simple transparency rule. That means you ignore the partnership or the family foundation, and you start taxing the people behind that. So that is a transparency rule which has come up for these two sections. Next comes a small business relief. Interesting point and very important for small business, where the income is not beyond the threshold. That means your income is not beyond 375,000. You are not using some of the criteria or not part of the exemption. Then you will be exempt from a corporate tax perspective. But there's a very underlying statement. Make sure you have your financials ready, so that if you have to challenge that, no, I am below 375,000 of the profit, you can substantiate it. So that's where the statement has to be maintained, books of accounts has to be maintained. This is very important from a section perspective. Next comes, there are a lot of exempt incomes. We talked about a couple like dividend. One is if you derive a dividend where the profit is already being taxed, corporate tax is paid, so there is no dividend tax to be per se as a very clear definition. So if a company has paid a corporate tax, whatever dividend you distribute on the tax paid income, that will not be double taxed. Very simple. Second, there are something called participating interest. Now, there is a possibility that you have investors in UAE who have invested in various countries. If your participating interest is more than 5%, that means you hold more than 5% shares, control, and you have a right of a profit. In that case, additional point, the taxes paid in that country from where you're getting the dividend is beyond the 9% or equal to 9%. So you have already paid taxes. Your control is more than 5%. That income, when received in UAE, will not be taxed. So similar sections are there, but it's very important that you should be holding that investment for more than 12 months. Other conditions need to be looked at in more detail. So on a top line or a highlight is simple, which goes into. Similar thing happens from a participating incomes from the capital gain perspective also, which will come into. And there is a very good exemption given to operating aircraft or ships in international transportation kind of a business. So if they're operating from a UAE, that are also considered as an exempt category of income. So this is where it comes into. We talked about qualifying income. So just to maybe rephrase that, 0% is only for qualifying income if you are a qualifying free zone, and 9% for non-qualifying income. So anything which is non-qualifying, there is no threshold, there is no 375,000 break which is available. It starts from a first dirham which you earn. A very highlight of the income calculation sheet which is available. So on a high level, if you see whatever profit you achieve as per accounting standards, international accounting standards, you start from there. And you can remove any adjustments which you had done from a capital perspective. If you've done any revaluation reserve for a capital, just remove that. Don't pay taxes. But from a tax perspective, keep counting the value of asset as an original asset. So any adjustment you did on a balance sheet on account of a capital asset, you don't have to pay any taxes for any revaluation. But if anything comes on account of working stories, stock adjustment, working capital adjustment, for those capital, any taxes are there, you will not remove, you will pay taxes specifically on those items. Other adjustments, there are specific expenses which are not allowed. On interest, there is a very clear exemption allowed up to a certain percentage. Beyond that, if you pay, that means that beyond EBITDA, if you pay, you have to calculate it back. So up to 30% interest is only allowed, which is as per calculation. Entertainment expenses only 50% allowed, whatever you do. Any kind of other illegal activities, if you do, you pay bribe, I don't think so we record in the books, but if you record, you will not be allowed any exemption for those. So that's very clearly written in the books also. So anything which is not related to business, unethical, not legitimate, will not be allowed as an expense. Other factors are you can even do a loss adjustment between the group and within the group also. So that provisions are also there. I'm sure Tally will organize some more events to get more deep dive into those points. And the biggest thing which comes after all these calculations and discussions is the transfer pricing. So I'll give a stage back to the team to invite the next speaker. Is the timing is fine or? Thank you.
Thank you so much, Rajiv ji, for such a wonderful presentation. I think by attending just this session itself, one can say that half of the questions that we had have already evaporated somewhere. Thank you so